38 years of professional experience together with high academic qualification, Mr. Yogesh P. Chatwani, sir, is very well respected professional and teacher. It is going to be an interesting learning session for the next 2 hours. So over to you, sir. Thank you.
Thank you, Kajal madam. Good morning to each one of you. Happy morning to each one of you. So today's our topic of discussion is evaluation of a distressed company. So as we all are aware, evaluation of a distressed company is a very challenging assignment. But the ground reality is, unfortunately, the professional fees which are given for such assignment, that is very low. Maybe this concept is evolving in India, and going forward, we may see actually a beneficial a professional fee, or at least a professional fee which are commensurate with this assignment. But nevertheless, as a professional, we have to do our duties, and the evaluation of distressed companies, that is very challenging. And as we all are aware, the IBBI played a very significant role in Solvency and Bankruptcy Board of India. That played a very significant role in introducing the concept of registered valuer in India. That was possible only after introduction of IBC, or Insolvency and Bankruptcy Code in India, effective from 1st of December 2016. And after taking up the importance of valuation, the government of India finally enacted or notified Chapter 17, or Section 247 of the Companies Act, by which the concept of registered valuer is recognized in India, effective from October 2017 onwards. And in October 2017, government of India notified companies registered valuer and valuation rules, which is again under Section 247 of Companies Act. So that is the background. And for the valuation of distressed company under IBC, as we all are aware, IBBI has issued several regulation, and we get guidance for valuation under the regulation, IBBI regulation. But in that regulation, there are scope for further improvement. So that we will discuss during our today's session of 2 hours. I have already made a certain suggestions to the IBBI. As we all are aware, as a registered valuer or as an insolvency professional, we are actually, we can give our suggestion for a further enhancement or improvement of the regulations, because that is a continuous process. So I have in that regard given a certain suggestion to the board, and it means just a few days ago. So let us see the outcome. But we will discuss those suggestions today. You all are actually learned professional. You all are also experienced professional. So this we will make it as a knowledge sharing session, so that we learn from each other. So with that brief background, since time is less and the coverage of this particular topic, as we all are aware, is very wide. So we will directly go to my presentation. So just give me a minute to share my presentation. So I hope my PPT is visible to each one of you. If you face any issue relating to visibility of my PPT, please inform me anytime. And if you have any question during the session, I request you to please unmute yourself and ask your question, so that we learn from each other. Whenever you are not talking, my request is please mute yourself, so that we can actually proceed in a peaceful manner. So valuation of a distressed company, that is our today's topic of discussion. And we will start with certain information which I have taken from the last issue of the newsletter, which is published by the IBBI, or Insolvency and Bankruptcy Board of India. So these A chart will give an idea about how many cases have been admitted in CIRP, Corporate Insolvency Resolution Process in India, beginning from December 2016 onwards. So, as we are aware, IBC was introduced in India in December 2016. So, till from December till actually December 2022, that is means the cases admitted to CIRP, that is around 6,200 cases, out of which around 4,200 cases have already been closed, and around 2,000 cases, these are ongoing. So CIRP, or a corporate insolvency resolution process, that is ongoing in 2,000 cases. And as we can see, actually the number of cases, these are declining over a period of time. That means there may be many reasons for that. Means like increase in a threshold. So after COVID, actually, as we are aware, government has increased the threshold of default. Earlier that was 1 lakh, and now that is increased to 1 crore rupees. So the operational creditors who are earlier making application for commencement of CIRP, those cases have gone down. And apart from that, because of these introduction of IBC, the discipline in debtors have also come, and they have become more conscious to pay their dues, repay their loans. And many cases are settled out of a court also. So that may be the reason. But this is the picture. 6,200 cases admitted so far, out of which 4,200 already closed, and process is ongoing in 2,000 cases. And it is very important to know exactly which sectors are not doing good, or which sectors are affected. So this chart will give an idea. Mainly it is manufacturing, real estate, and construction. So if we add these three sectors together, so as we can see, it will give more than 70% of cases, with manufacturing highest at 39%, real estate at 21%, and construction at 11%. So that will give a total 71%. So as we are aware, as we have three approaches of valuation: market, income, and cost. So worldwide, there are 11 sectors which are recognized. And under those 11 sectors, there are 50 plus industry group. And under those 50 plus industry group, we have 150 plus sub-industry. So all this company will fall under this hierarchy. And as a valuer, it is very important to know the exact characteristics of the company of which we are doing the evaluation, because characteristics of each company, you will appreciate that it will differ from industry to industry, or sector to a sector. So this is the brief background about the companies which are affected. And moving forward, actually, as we are aware, the means CIRP application for commencement of corporate insolvency resolution process, that can be done by three categories. Number one, a financial creditor. Financial creditors are mainly banks and a financial institution who give finance, who provide a finance to a corporate person against time value of money. So that is financial creditor. Operational creditor will include those creditor who supply goods or services, or employees of the company or the government use. And a company itself, corporate debtor itself, can also file an application. And we all are aware, in the recent past, Gold Airways has also applied for a CIRP proceeding. So this is the trend. As we can see, the financial creditor, they have filed around 2,700 application, followed by operational creditor, 3,100 application, and the company itself or the corporate persons itself or corporate debtor itself, they have filed around a 370 application. And this is the means as we are aware, the prime motive of CIRP, corporate insolvency resolution, that is insolvency resolution through ownership transfer. So the company or the corporate debtor, management of that is handed over to the new management. That is the primary goal, insolvency resolution through ownership transfer. But if it is not materialized, then a second course of action is liquidation. So as we can see, around 76% that was actually means from either a BIFR or the non-functional. So as we are aware, a BIFR, that is means that was in vogue before introduction of IBC in India. So this actually when IBC came into existence, all this will be were transferred. All these cases were transferred to IBC. So that constituted around a 76%, and the balance were 24%. And this actually we are aware all the processes under IBC, that is time bound process. A statutory time limit is fixed. So CIRP, as we are aware, original time limit is 180 days, and that can be extended for 90 days maximum, one extension only. And if certain exceptional circumstances are there, some litigation is ongoing. So in that case, it can be extended maximum up to 340 days. So that is the maximum timeline. So this chart will give an idea of the ongoing case. So in case of 270 days or more, that is we have maximum cases 64% are ongoing for 270 days or more. That is 180 days plus 90-day extension, that is 270 days, and less than 180, greater than 180 days, but less than 270 days. These cases are around 14%. So this will give an idea about how this CIRP process is continuing. And this is again a status of a CIRP, which we already covered. And here actually it will give how many admitted, how many closed on filing appeal and all. So that just for information I have incorporated here. And this chart is about the liquidation. So for liquidation, as we all are aware, original time limit was of 2 years, but that is now reduced to 1 year. So as we can see from this chart, around 51 cases of liquidation. These are ongoing for more than 2 years, and 25% cases that is greater than 1 year but less than 2 year. So that will give an idea about ongoing liquidation cases. So now we will start with what is the meaning of distressed companies. So when we are doing evaluation, it is very important to know the exact meaning of the distress. So a distressed company, that is a business that is experiencing a financial difficulty or is in a financial distress, which is frequently caused by a factor like a declining sale, excessive debt, or a poor management decision. So that is the primary meaning of the distressed company. And a distressed company, they may face a range of challenges, which will include a difficulty in paying their bills or a difficulty in meeting their financial obligation, like a repayment of loans taken from banks and a financial institution, or the declining customer base, or the declining market share, and a loss of key personnel. So a distressed company may also experience declining in their credit rating, which will make it difficult to obtain finance or access a credit market. And even if they get opportunity to access the credit market, that will come as a cost, because the rate of interest will be more as compared to which is offered to a solvent company. So insolvent companies will face enhanced cost in taking a finance. And in some cases, a distressed company may be able to turn their financial situation around through restructuring or a turnaround plan, which may involve a selling of asset or a cutting of cost or a restructuring of a debt, etc. So that we all are aware, and a distress that is a compromise or arrangement. And in Companies Act, as we are aware, provisions have been made relating to compromise and arrangement. So by doing that, if company comes out of insolvency position or from a distress state of affair, then it is good for not only for the company, but that is good for a country as a whole, for economy as a whole. So if a distressed company is unable to improve its financial situation or attract new investor, so it may be forced to declare the bankruptcy and go through a process of liquidation or a reorganization. So that is the meaning of a distressed company. And there are mainly two types of distress, which will cover the economic distress and financial distress. So as we all are aware, at present, we are going through the most challenging or a difficult time, perhaps of our lifetime, because all it started with the COVID 2019. And as we are aware, in India, effective from March 2020, last week of March 2020, nationwide lockdown were imposed, and that actually became a global phenomenon. So by and large, all countries, they have controlled the pandemic. But after that, as we all are aware, there is ongoing war between Russia and Ukraine for more than 1 year now. And as we are aware, the Russia, that is a third largest exporter of petroleum product, crude oil and various finished petroleum product. And the Ukraine and Russia, they are also exporter of various commodities. So because of that war, the supply chain across the globe and a logistic arrangement across the globe, because these two countries are located at a strategic place. So supply chain and a logistic chain that is disrupted to a very large extent, and a pain of that is felt by all the countries, and particularly as we can see, many countries are they are actually have a negative impact on their macroeconomic condition. We are aware about the macroeconomic condition prevailing in our neighboring countries like Pakistan and Sri Lanka. So that phenomenon we can see in other countries also. So that is the impact of war. And because of that war, actually, the diplomatic relations between major countries like USA and Russia, or Russia and European country, or USA and China for the Taiwan issue. So actually, because of all this and many more such factors, the diplomatic relation between major countries in the world, that is not improving, that is deteriorating day by day, and this is not good for the mankind. And this is the factor we need to consider, because in evaluation, that is an estimate, and that will depend on a future projection. So because of all these development, we are not under the control of the individual company. So many companies, they may fail the feel the financial distress. So that will fall under the category of economic distress. And economic distress, that is not within the control of the management of a individual company. So economic distress, that refers to condition where an economy is experiencing a period of recession, depression, or a severe economic downturn. And economic distress, that is characterized by a decline in economic activity, raising unemployment, a falling income, and a decrease of business investment. So these can be caused by a range of factors, including global economic condition, government policy, market fluctuation, natural disasters, public health crisis. So all these are a factor for economic distress, and that can lead to negative consequences for individual and businesses, including a decreased access to a credit. So as we are aware, actually during COVID, the major economics, they gave a freebies to the its citizen to come out of the that pandemic situation. That was good at that time, but pain of that we are feeling now. Because of that, actually the rate of inflation has gone up considerably, and to control it, the central bank across the globe or across the world, they are increasing the rate of interest, and that rate of interest has another a negative impact. Like as we are aware, in the recent past, many banks have failed because of that. So all this chain effect, and that is not within a control of individual or a individual company. So government and central bank frequently implement policies and program to help alleviate economic distress, like a fiscal stimulus program, monetary policy measure. Monetary policy, as we are aware, that is controlled by central banks, and this fiscal stimulus program that is given by a central government. So emergency lending facility. So this can have a ripple effect throughout the economy, affecting industries and a sector differently, with some being hit harder and others these are benefited. So COVID also, as we see for hospitals and a medical fraternity, that was painful but beneficial, and for other industries like travel and tourism, so that created a negative impact. So any event that have some positive impact on some sector and a negative impact on some other sector, so that as a valuer we need to identify whether the companies we are actually making estimate of valuation, whether that is positively impacted or negatively impacted because of current macroeconomic factor. So economic distress can be challenging a time for a business and individual. It can also present opportunities for growth and innovation, as company may seek new ways to adopt changing market condition and consumer behavior. So our today's session, this virtual session, that has become possible due to COVID, thanks to COVID. Otherwise, earlier, as we all are aware, such sessions were mainly do physical. So that is one of the example which is changing way of consumer behavior. Moving forward, types of these are company specific. So we have already referred to the economic distress. Now we will go to company specific distress. So as we are aware, the management of the company or promoters of the company or the morale of the employees or the location of the company or the product in which a company is dealing or the customer relationship which company is maintaining, all these factors are within the control of the company, and that is if not controlled, then that may result into a financial distress. So a financial distress can occur when a company is unable to meet its financial obligation, like paying bill, servicing debt, paying employee. Financial distress that is frequently caused by a factor like a declining sale or a raising cost or excessive debt. So we have a financial distress, and we can have operational distress also, which will come in the category of company specific distress. So these will occur when companies' operation are not running efficiently, leading to decreased productivity, increased cost, lower profitability. And these can be caused by a factor like poor management, outdated technology, inadequate staffing, and all. So that is operational distress, and then we can have market distress, another category within company specific distress. So that can occur when a company will face a decline in demand for its product or services, which will lead to lower sales and revenue. And that can caused by factor like increased competition, changing consumer preference, shift in the economy. So we all actually are aware of these kind of market distress. So apart from that, we can have legal distress that can occur when a company will face legal challenges like lawsuit, regulatory fines, government investigation, and that can cause by a factor like non-compliance with laws and regulation, a dispute with stakeholder, unethical business practices and all. And we can have reputational distress also. A company's reputation is damaged, which will lead to a decreased customer loyalty, loss of business, and a negative publicity. So reputational distress that can be caused by a factor like public scandal, negative media coverage, or a social media backlash. So in today's world, as we all are aware, social media also plays a very important role in a functioning of a company. So actually company specific distress, this can be divided into 5 categories, starting with financial distress, operational distress, market distress, legal distress, and reputational distress. So we have actually covered a major category, economic distress and a company specific distress. Again, in a company specific distress divided into 5 parts. So that we have covered. And now actually it is very important to identify the exact type of distress in any evaluation exercise. So identifying the correct type of distress, that is a very essential to accurately estimate the value of a distress company. So different types of distress can have a different impact on companies' financial performance and a future prospect, and that can affect its evaluation. So if we take one example, a financial distress, so that is one of the 5 company specific distress, as we have seen, a financial distress. So that actually may be temporary and could be resolved with improved cash flow management, while operational distress that may require more significant changes to company's operation or a management structure. So that is very important, whether because the valuation that deals with projections, and a projection will be possible only when we know the exact type of distress, and whether there is a possibility of coming out of that distress or not. So that is very important. And identifying a correct type of distress that can help investor and valuer to determine whether a distressed company has the potential to recover and regain profitability, or whether it is at a risk of liquidation or bankruptcy, or winding up, whatever name we may call it. So very important. And understanding the type of distress that can help investor and valuer to assess the level of risk associated with investing in a distressed company, and determine an appropriate discount rate or required rate of return. So very important, ascertaining the discount rate in any valuation estimation, particularly under income approach or a DCF method. So very important, and that is a required rate of return for investor also. So accurately identifying the type of distress that can also help determine appropriate valuation methodology. So if we take example, a discounted cash flow analysis that may be more appropriate for a distressed company which is experiencing a financial distress, while a liquidation evaluation method that may be more appropriate if a company is in legal distress. So based on type, we may decide the appropriate evaluation approach or appropriate evaluation method for arriving at the estimate. So correct identification of type of distress, that is crucial for estimating the value of a distressed company and making informed investment decision. Very important. And now these are the indicators. So post-mortem, if we do, that may not help. The progressive management, or as a advisor or as a consultant to the company, we need to identify the indicators in advance, and if company management is willing, and they can take action for avoid the insolvency. What are the indicators? These are the indicator, and this list is not exhaustive. This is just an illustrative list. So apart from this, there can be many more factors because of which a company may go into insolvency or in liquidation, like a position. So a declining revenue, rising cost, negative cash flow, decreased profit margin, high debt level, poor credit rating, reduced market share, reduced employee morale, legal or regulatory problem, board or executive changes. So all these are actually the possible reasons for insolvency, a possible reason for distress. And we can discuss this in greater detail, but looking at limited time, we will skip that, and we will now go to the prediction model. So very important, based on a certain financial ratios, we can predict the bankruptcy or insolvency like a position or a distress in advance. And there are again many progressive management who actually regularly make use of various distress company prediction model. These prediction model, these are used to identify company that are at risk of financial distress or bankruptcy. And these model typically use a range of financial and non-financial data to identify a pattern and trends that may indicate a financial distress. So concept of a bankruptcy or a distress that is getting a wide coverage in India from the recent past, but in advanced country like Europe, USA, European country, and Singapore, they are making use of this type of distress prediction model from a very long time now. And we can get ample guidance on these type of model on internet. On a need basis, we can make use of that. And even for academic purpose, we can make use of that. So this model, this can be based on various financial metric like debt to equity ratio, cash flow earning, and liquidity ratio. So this model that can be useful for investor, creditor, and a valuer to assess the financial health and a potential risk associated with a company's operation. So each company that is unique and multiple factor may contribute to its financial difficulty. So that we need to keep in mind. And we have actually very popular model, which we call it as JETA model or JET score model or Altman model. So that is actually developed by Professor Altman in 1968 to predict the bankruptcy. So in India, we know it as a liquidation, but in USA and all, they know it as a bankruptcy. So bankruptcy, according to IBC in India, that is for individuals and a partnership firm, and a company, we know it as a liquidation. But there is no actually a difference between bankruptcy and liquidation. All this will ultimately result in a winding up of the business entity. Professor Altman that developed a JETA model or JET score model or Altman model way back in 1968 to predict the bankruptcy. And these model use 5 financial ratio, which are working capital by total asset, retained earning by total asset, earning before interest and tax by a total asset, and then we have market value of equity by book value of total liability, and sales by a total asset. So out of 5 financial ratio, as we can see, the denominator is a total asset. So that is the importance of a total asset. So each ratio that is assigned a certain weight, and that will produce a single score that will indicate a likelihood of the bankruptcy. So what are the rule of interpretation? So that is given here, so that we will see in subsequent slide. And Mr. Prasantji, means you have any questions, sir?
Yes, sir. One question, sir.
Yeah,
So
please, sir.
you mentioned about bankruptcy in US and liquidation here.
Yeah.
So essentially in US also the bankruptcy is for going concern, or is it non-functional company which goes for bankruptcy?
Okay, so sorry, as you may be aware, in a US bankruptcy law, we have a Chapter 7 procedure and Chapter 11 procedure. So Chapter 7 is for revival, and Chapter 11 is for liquidation. That we will cover in a brief detail, but that is a vast subject. So mainly they know it as Chapter 7 and Chapter 11 procedure, filing under Chapter 7 and filing under Chapter 11 of US bankruptcy law. So that is again a very important, and we will cover in brief detail during this presentation.
Okay. Okay. Okay.
So
Thank you, sir.
apart from that, any further questions, sir?
No, sir.
Thank you, sir.
Thank you.
So Altman score has been found to be effective in predicting a bankruptcy for both a public and private company. And this model was originally developed for a manufacturing company, and that may not be effective for other industry. But this Z score that is used widely for investor, creditor, valuer as a tool to assess a company's financial health. So very important. And this is the formula for this Jetta model or Altman model. So as we discussed in a previous slide, there are 5 financial ratio based on which this Altman score is computed. So we have a working capital by total asset, retained earning by total asset, and then we have total sales by a total asset. We have earning before interest and tax by total asset, and market capitalization by a total liability. So weight given a ratio number 1, that is 1.2, ratio 2 1.4, ratio 3. So greater importance to ratio 3, which is earning before interest and tax by a total asset. Earning, as we all are aware, that is will have always upper hand, because if a company is not earning, not generating revenue, so ultimately in the long run it will fail. So very important, earning before interest and tax by a total asset, highest weight of 3.3, then ratio 4.6, and a ratio 5 1. So this is actually the division of weight, as we discussed. Highest weight of 44% given to ratio 3, which is EBIT by a total asset, followed by a 19% to ratio 2. So ratio 2, as we are aware, that is retained earning by a total asset. Very important, whatever earnings are there of a company, that can have a 2 use mainly. That usage of that can be divided into 2 categories. Number 1, distribution as a dividend to the promoter or shareholders or owners of the company or a business entity. So that is one usage, and a second usage is retain in a business for a future growth. So what a dividend policy company has adopted, or how much earnings are retained in the business for a future development or for a future growth, that is also a very important, because ultimately whatever you are, if you distribute by way of a dividend or take out of business, then a prospect of a future growth will be reduced. So very important to retain earnings in the business. So a second highest weight of 19% that is given retained earning by total asset, and a third highest 16% that is given to ratio 1, which is working capital by total asset. Management of working capital very important. optimal level of working capital. To maintain that is a challenge for management of any company, because if you have a working capital bigger than what you need or more than what a company needs, then it will affect the profitability. And at the same time, if a level of working capital, which will include a case and case equivalent inventory credit policy of the company, if that is less than what is required, so ultimately the company may lose its customer, because if inventory is not sufficient to meet the customer demand, so ultimately in a long run, a company may lose the customer, because a customer once out of company may never return. So that will affect the profitability of the company. So very important, the working capital, level of working capital by a total asset, and then we have 8% weight to ratio 4 and a 13% to 15. And this is the method of interpretation of a Z score. So if the score which is arrived at by these 5 ratio calculated in this manner and assigning this weight, if it is between 0 and 1.8, so company can be regarded in the distress zone. If it is between 1.8 and 3, so that is gray zone, and above 3, so that is considered to be the safe zone. So this is the way this Jetta score is interpreted, and we can make use of that. We can select a company of our choice and compute this ratio. Mainly, we can get a detail about this from the financial statements of or annual report of a company, and it is not difficult to get annual reports of listed entity. We can easily get that from a website of the respective company or from the website of a stock exchanges. So this is how actually interpretation is made, and we can make use of these actually in valuation of a distressed company actual case study basis. And by that, we can come to know whether a company will come out of the distress or a possibility of company becoming solvent again. So based on that, we can make a projection whenever actually we are making a projection, taking assumption of going concern. So mainly in DCF or under income approach, the assumption of a going concern, that is very important. So in that actually we can have a fair idea of what are the chances of a company again becoming a solvent or a revival or coming out of the financial distress, so that we can ascertain very well from this ratio. So apart from that, there are many other bankruptcy prediction model, and all information about these is freely available on the internet. So based on our academic interest or our professional interest, we can make use of that, because internet, as we all are aware, that is super highway, and we can get any information, and particularly in this era of artificial intelligence or a chat box, not difficult to get the information which we require. So very important. We can have O score, M score, C score, neural networks. So all these are model. I have just highlighted this. I will forward this PPT to the organizer of this event. So based on our need, we may go into a further detail. So O score model, M score, C score, a neural network, and this is our own model. So very important. This NCAER. So that is very important. Our Indian model. So that also gives an idea. So we will go into a detail of that. So according to National Council of Applied Economic Research or NCAER, an industrial undertaking. So this is applicable only to the industrial undertaking and not to a trading entity or not to a service company. So very important to know, this is applicable only to industrial undertaking. Means an industrial undertaking that may be financially viable if three elements are approved to be positive. So according to this NCAER study on a corporate distress prediction, they have prescribed three element or a parameter for predicting the stages of a corporate sickness. So it is not that overnight a company will become a distress or a company will become or insolvent. That is a continuous process, and that may continue for a 2 year for a particular company, or 4 year, or 1 year, or 6 months, depending upon the level of distress. It is a disease, so a disease will take its own time to spread further. So in that connection, this is very important to know the level of distress. And again, I will highlight this is applicable only to the industrial undertaking. So we have case profit position, so profitability measure, net working capital position, liquidity measure, and net worth position. So that is a solvency measure. So if in a firm, if any of the above three element or a parameter, these are found to be negative. So either a case profit position is a negative. So here case profit, here we are not seeing the profitability, we are insisting for the case profit. So certain items of expenses which are attached to income statement or a profit and loss statement, that is non-case item like depreciation, amortization, etc. So that we need to means add back to the net profit. So we need to take the case profit. So either case profit position is in a negative, or a net working capital that is in a negative, means current liability is more than a current asset, or a net worth position that is negative. So that will give an indication about distress. So in a firm, if any of the above three element or a parameter, any one of above or two of above are found to be negative, so that may be considered that a firm has a tendency of becoming sick. So that is one out of three parameters or three element. If two of the above three elements or a parameter, these are found to be negative in a firm, so that may be considered that a firm purchases incipient sickness. And if all above three element or a parameters, these are found to be negative in a firm, so that may be considered that the firm is fully sick. So these are the level of sickness or a level of distress, and this is again developed by our Indian institution. So on again a need basis, we may make use of this, or we may actually visit the website of National Council of Applied Economic Research, and we will get many useful information like that from this website. So moving forward, actually in India, we do not have any standards for evaluation of a distressed company. And there is a need now to have the separate standards for evaluation of a distressed company, because the normal standard, maybe it is international evaluation standard or ICAI evaluation standard. As we are aware, in India, Institute of Chartered Accountant of India, they have published their own evaluation standard. So whether it is IVS, International Valuation Standard, or whether it is ICAI evaluation standard, we may not get the proper guidance or a specific guidance or a specialized guidance on evaluation of a distressed company. So in a USA, we have this valuation, distressed company, a distressed business valuation, or a distressed business evaluation standard. And these are developed jointly by AICPA, American Institute of Certified Public Accountant, and the Association of Insolvency and Restructuring Advisor. So again, these standards are available on internet free of cost. So based on our interest and our requirement, we may download that. That will provide a very useful information, particularly for evaluation of a distressed company. So AIRA, or Association of Insolvency and Restructuring Advisor Standard for a distressed business valuation, these are a set of guidelines that provide a framework for a valuation of distressed businesses in the context of insolvency and restructuring. So I will like to make it clear, these are not regulatory standard. These standards are developed by the professional, we all are insolvency professional or a registered valuer. We are independent professional. We may help each other by developing a certain standard or a certain guideline based on our experience for evaluation of different classes of asset. So that initiative is taken in USA by this Association of Insolvency and Restructuring Advisor. So all these are professional. So that I will actually again highlight, these standards are just for a guideline. These are not a regulatory standard. These are not a statutory standard. So we can make use of that as just for a guideline purpose. We cannot prepare a valuation report which is compliant on AIRA distressed business valuation standard. So that we need to understand, that we need to keep in mind. So these standards were developed to promote consistency and transparency in the evaluation. So as we are aware, a different valuer may do evaluation differently. So to guide the valuer, these type of standards are developed, and it will be of ample help if somebody amongst us take the lead to develop such standard based on our experience. So these standards were developed to promote consistency and transparency in evaluation process, and to provide guidance to practitioner. So it is again provide guidance to practitioner who are engaged in valuing a distressed business. So in a USA or in a developing country, a valuation of a distressed company that is of a paramount importance, and they get a very good remuneration. That is a branch in itself, and they get a very good remuneration for evaluation of a distressed company, because there actually the court also, the bankruptcy court in USA of different states, so they actually means they also make it a point to scrutinize the evaluation report. So very important. So standard cover a range of topics, including a scope of the valuation, selection of appropriate valuation methodology, the consideration of market condition, and a treatment of uncertainty and risk. So these standards emphasize the importance of understanding the specific circumstances of the distressed business being valued, and of tailoring the evaluation approach accordingly. So these I will again highlight. Each distressed company will have its own peculiarity. We just cannot make all distressed company into one bucket and make valuation. So a tailor-made approach is a very important, tailoring the evaluation approach accordingly. So in actually our CIRP regulation, so that we will discuss, there actually the valuers are appointed asset class wise, and not for making evaluation of company as a whole, because what is the primary purpose of CIRP? Primary purpose of a CIRP is not winding up, not a liquidation. The primary purpose of CIRP is insolvency resolution through ownership transfer. So once ownership transfer is contemplated, so naturally it is expected that a company will function as a going concern. So when you are dividing asset of the company into three parts, land and building, plant and machinery, and SFA, can going concern assumption be attached? You are dividing a family into three parts, and then you are showing it is a one family. How it is possible? So that we will discuss in a further detail. But here I would like to highlight valuation approach needs to be tailor-made for each company. It should not be imposed upon the valuer by a regulation, or it should not be imposed upon resolution professional to necessarily appoint a three valuers in a three different asset class. So that we will see in greater detail later on during this session. So this AIR standard require that evaluation report include a clear and concise description of evaluation process and methodology used, as well as a discussion of the key assumption and input which are used in this evaluation. So as we are aware, in the recent past, disciplinary authority of the disciplinary committee of the authority, or IBBI, they have issued several disciplinary orders against the registered valuer. And one of the important finding is a non-incorporation of vital details like the evaluation process or a methodology used in the evaluation report. So very important. We can get guidance on that from this AIRA standard. So this standard require evaluation report and need to include a clear and concise description of the valuation process and a methodology used, as well as a discussion of the key assumption and input used in the evaluation. And these standards also require that evaluation report include a discussion of the risk and uncertainty associated with the valuation. Valuation estimation as it is a uncertain, full of uncertainty, full of risk. Projections are full of risk, and that will be a degree of that will be higher in case of a distressed company. So a standard will emphasize the importance of maintaining independence and objectivity in evaluation process, and disclosing any conflict of interest or a potential bias. So that is again a very important. And these standards stress the need for ongoing professional development and education in a field of distressed business valuation, and importance of staying up to date with development in the field. So these type of virtual session, a need of the hour is to actually make it a regular phenomenon, a regular event, and based on our personal experience, we may share with each other and gain knowledge out of that. Very important. And now we will review the factors and the issues which are involved in a distress, which are involved in evaluation under income approach. So as we are aware, there are three approaches. So we will first review the income approach. So selecting industry-based cost of debt versus actual cost of debt, or a future restructured cost of debt. So we will have three types of cost of debt because as we are aware, ultimately a discount rate, whether it is based on cost of equity or whether it is based on a weightage average cost of capital. So debt, cost of debt will play a significant role. So cost of debt that can be divided in three parts. Number one, industry-based cost of debt. So what is the cost of debt of industry as a whole? So that one information we can get. Number two, cost of debt, actual current cost of debt. So as we already discussed, the companies in distress that they may face a difficulty in getting or raising finance, and because of that, the cost of debt will go up considerably. Because when you are in distress, nobody would like to provide a finance to you, and because of that, current cost of debt will go up considerably. And means if some type of compromise is proposed with the creditors, then a future restructured cost of debt that may be different. So whether to consider one out of these three types of debt, that will be a challenge. And again, we cannot have a ready-made answer to that. That will depend upon a case-to-case basis or a ground reality of each case. Then a cost of debt and the relative weight of debt in a capital structure that can be affected measures of the market value of debt versus a book value of debt. So that is again a very important because in means weightage average cost of debt, we take the market rate. So whether to go by the cost of debt as per books or as per market, that is another consideration. And the debt beta over a varying length of time, actual versus targeted leverage. So financial leverage, actually, as we are aware, that also plays a very important role. And the in a capital structure, the ratio of equity and a debt that may actually undergo change during a distress of a company. So very important to actually measure the means financial leverage. So again, that is very important, and the impact of tax and other item which needs to be considered. Means company may have a tax asset. So if a company will become profitable, that assets can be made use of. So all these factors need to be considered, very important, and selecting industry-based cost of equity versus a risk-adjusted cost of equity, either current or in a future forecast. So again, that is a very important. So what we discussed about debt, that will be applicable to equity as well, because capital structure is comprising mainly of two elements, equity and debt. So cost of equity and relative weight of equity in the capital structure, because a weightage average a cost of capital will also consider a weight of equity and a weight of debt in the capital structure. So cost of equity and a relative weight of equity in a capital structure that can be affected by measures of market value, equity return, measures of equity beta over a varying length of time, actual versus targeted leverage. What is the current financial leverage versus what is a targeted financial leverage, and differing measures of equity risk premium like backward and forward looking, impact of tax and other items which needs to be considered. So these are actually the factor and issues which are involved in evaluation of a distressed company. And these are the challenges when we will do valuation of distressed company going by the income approach. So difficulty in projecting the future cash flow, as it is we find it difficult to project future cash flow of a solvent company. So in case of insolvent company, or in case of distressed company, a degree of that will further go up. So very important. So just give me a minute. I will just take 1 minute. In the meantime, if you have any question, you are free to ask.
केरला वगैरह चलता है पूरी तो मजा वाला लग बोटिंग नहीं होगा.
Any questions, sir?
No sir, no, sorry.
No issue, no issue. Thank you, sir. Thank you. So we will move forward. This income approach, these are the challenges. A difficulty in projecting a future cash flow. So income approach, as we are aware, relies on projecting a future cash flow and discounting them to their present value. So in a distress situation, there may be significant uncertainty regarding a company's ability to generate a future cash flow, and that can make it difficult to project these cash flow with any degree of certainty. Then adjusting unusual expenses or revenue. So as we are aware, a projection first needs to be normalized. In any company, there will be certain abnormal expenses, and that will be more when we are doing evaluation of a distressed company. So making adjustment of that, or making a normalized earning very important. Unusual expenses or a revenue in a distress situation, company may have experienced unusual expenses or a revenue that may not be a representative of company's ongoing operation. So very important to adjust for these items accurately to project the future cash flow. And then changes in a capital structure, we already discussed a ratio of debt and equity or a financial leverage. Company may undergo significant changes in its capital structure, which can impact the company's future cash flow, and appropriate discount rate to use it in the evaluation. So adjustment may need to be made to reflect changes in debt level, interest rate, and other factors. Very important. And then difficulty in determining the discount rate. So appropriate as it is to decide the appropriate discount rate in case of solvent company also is challenging. So that is more challenging in an insolvent company. This appropriate discount rate to use in income approach, that is dependent on a number of factors like riskiness of a company and its operation. And in a distress situation, particularly a riskiness of the company that may be elevated or that may go up, which can make it challenging to determine an appropriate discount rate. Then a need of a sensitivity analysis. So as we are aware, very important in a DCF to do the scenario analysis and a sensitivity analysis. So that actually integral part of any DCF model or any financial model. Very important scenario analysis and sensitivity analysis. In Excel, actually, we can make use of a data table for do the sensitivity analysis, which can be made on some important variable. So as we are aware, a DCF is comprising of many variables like the growth in revenue, rate of growth in revenue, or terminal growth rate, or a cost of capital, or a weighted average cost of capital. So these are the important variable in DCF or analysis or in a financial model. So we can make use of sensitivity analysis and MS Excel, that as we are aware that support sensitivity analysis based on two important variable, any two important variable. So very important sensitivity analysis, and due to uncertainty involved in projecting future cash flow, it is important to perform a sensitivity analysis to determine the impact of changes in a key assumption on evaluation. So this assumption or variable, as we discussed, that can be terminal growth rate or a weighted average cost of capital or a rate of growth in revenue. So these are important assumptions in evaluation under a DCF, and a distress situation. These analysis may be particularly important given the higher level of uncertainty and a need for a realistic business plan. So income approach relies on projecting future cash flow based on a realistic business plan. So in a distress situation, very important to develop a business plan that is achievable given the company's current circumstances and a constraint. So these are actually an impact of macroeconomic factor. So income approach may be impacted by macroeconomic factor. We already discussed about that in the beginning. So like changes in interest rate or overall economic climate. So distress situation, these factors may have an greater impact on evaluation. Overall, challenges of valuing a distressed company under income approach are significant, and that will require careful consideration and analysis. And evaluation must consider specific circumstances of the company and a potential impact of changes in its operation, capital structure, and overall economic environment. So this is a brief about challenges of income approach. Difficulty in future projecting future cash flow, importance of adjusting unusual expenses or revenue, impact of changes in capital structure, difficulty in determining appropriate discount rate, a need for sensitivity analysis, also a scenario analysis, and a need for a realistic business plan coupled with the impact of macroeconomic factor. So these are the challenges under the income approach. And moving forward, we will go to the challenges under market approach. So a lack of a comparable company. So in case of solvent company also, we face that. That will be more in means distressed company. So on a lighter side, in our personal life, we always say the nature of two brothers and a sister is not same. That will vary actually. So how to get a company in the marketplace which is just similar to the subject company or the target company. So very difficult, very challenging for a valuer, particularly in a distressed company. So lack of comparable company. So may not have comparable publicly traded company that are similar in terms of size, industry, and financial performance. So that will make it difficult to use market multiple to estimate the value of the distressed company. So what is the way out? What is the remedy to come out of that? We can actually make a use of a market multiple, considering the target company or a subject company as a solvent, and then whatever valuation estimation is arrived at, then we can make a suitable adjustment for giving effect of a distress condition. So that is one way or one method to coming out of this one remedy, a suggested remedy, not only a way of dealing with this. And illiquidity discount. So distressed company are frequently illiquid. So discount of lack of marketability, as we all are aware. So that needs to be considered in a solvent company also. So that that actually needs to be considered in a distressed company, illiquidity discount. So these are frequently illiquid. Nobody would like to purchase a distressed company, and the market may apply a discount to the value of company to reflect the illiquidity. So this discount may be difficult to estimate, especially if these are no comparable transaction. Then market volatility, again, very important. So market approach relies on market data, which can be volatile, especially in times of economic uncertainty. Overnight, as we are aware, because of certain news, few days back, HDFC twin equity share declined to 5 to 7%. So a volatility, market volatility plays a very important role in valuation projection. So market approach relies on market data, which can be volatile, and especially in times of uncertainty. So this can lead to inconsistent valuation and makes it difficult to determine an accurate value of the distressed company. Moving forward, market inefficiency. So a distressed company may trade at a discount to their intrinsic value due to market efficient, because market value, as we are aware, that is based on the perception of the investor, and nobody would like to purchase a distressed company. So perception about a distressed company may be negative, and many times that may be less than the market value, may be less than intrinsic value of the company. So that is also a challenge. Timing issue, a market approach require a valuation date, which can be challenged for a distressed company that are undergoing rapid changes in their financial performance. So this can make it difficult to determine an accurate value of the company. So based on the current financial data of a distressed company, if we try to make a valuation going by market multiple or a market approach, so that condition may change a very near future. So that will be actually timing issue will also crop up when we are doing valuation by market approach. And a distressed debt. So distressed company may have a significant debt obligation, which can complicate the valuation process. A value of the debt may need to be estimated separately, and of the impact of debt on a value of company. that need to be considered. So that is about the market approach, challenges in a market approach. And these are the challenges in a cost approach, obsolescence. So cost approach rely in estimating the cost of replacing the company asset. And in the case of a distressed company, this asset may be obsolete or in a poor condition, which can make it difficult to estimate their replacement cost, very difficult, because at the same degree of operational efficiency, we need to ascertain the replacement cost under cost approach. Particularly in case of distressed company, that will become more challenging. And depreciation, a cost approach assumes that asset depreciate over time, but the rate of depreciation may be difficult to estimate for a distressed company with uncertain future cash flow. So as we are aware, the concept of depreciation under a valuation standard, these are different from a concept of a depreciation under a financial reporting standard, whether it is IFRS or Ind AS. So a depreciation in valuation is not what we traditionally understand by a book value by a financial reporting standard. So very important. And a going concern assumption. So cost approach assumes that company will continue to operate as a going concern. This may not be the case for a distressed company, which may be at risk of a liquidation or the bankruptcy. So these are the challenges under a cost approach, and continuing with that, incomplete information. That we face frequently whenever we approach to the resolution professional for providing certain information or document of the corporate data. We actually hear from him the document or information which are required by us are not available. So that is also a challenge, incomplete information. So distressed company may not have complete information about asset, liability, or a future cash flow, which can make it difficult to estimate their value using the cost approach. And then a value of intangible asset and a lack of a comparable. All these are challenges in a cost approach. And these are the challenges in evaluation of intangible asset. So as we all are aware, as it is evaluation of intangible asset, that is very difficult. And that is difficult because as we are aware, the internally generated intangible asset or a homegrown intangible asset, these are not reported in the financial statement as per guidance provided under the accounting standard, whether it is IFRS or whether it is Ind AS. So because of that, we cannot get a benchmark or a threshold in a financial statement of the company. So very difficult to get information about the intangible asset. And actually, according to finding of a recent survey, around 2/3 of the value of intangible asset globally that is not a part of the financial statement because of guidance provided in the accounting standard. So now experts say it is a time to go tangible about intangible asset, meaning thereby some type of guidance is required for a reporting of internally generated intangible asset in the financial statement. So in case of a distressed company, again, that will be very difficult. And these are the challenges in means valuation of intangible asset of a company under a distress. So a difficulty in establishing a market value. So intangible asset like a patent, trademark, proprietary technology, all this comes under IPR or intellectual property right. So that can be difficult to value since they may not have a market value that can be easily established because patents are granted for what, as we all are aware, the patents are granted for new innovation, new means discovering a new operational procedure or a new product. So that will be a very difficult to get a market information about that. So difficulty in establishing the market value. So that is again very important in case, particularly in case of IPR. Then uncertainty regarding a future case flow. That is again a very difficult, because intangible asset are frequently valued based on the future cash flow. So as we are aware, out of three approaches, mainly intangible assets are valued by income approach, and there are 5 methods for evaluation of intangible asset under income approach. So income approach needs a projection about future cash flow. So that will be uncertain in case of a distressed company. Means in a distress situation, there may be greater uncertainty regarding company's ability to generate such cash flow, which can impact the evaluation of intangible asset, and lack of historical financial information. So as we already discussed, the company may not have a long operating history, or may have limited financial information available, which can make it difficult to determine a value of intangible asset based on a past performance, and a difficulty in distinguishing between different types of intangible asset. So as we are aware, brand equity, goodwill, these are various types of intangible asset. And to bifurcate the value, supposing I am spending 1 crore rupees on advertisement. So because of that, whether the brand value of the company has gone up, or whether the goodwill of the company has gone up, or whether the customer relationship of the company has improved. So all these are different types of intangible asset, and that will be very difficult to allocate the exact economic value to each these different types of intangible asset. So that is also a drawback. Difficulty in distinguishing between different types of intangible asset. So a legal and a regulatory risk, importance of identifying a key intangible asset, and a difficulty in estimating useful life or a useful economic life. So all these are challenges in evaluation of a valuation of intangible asset, and particularly with reference to a distressed company. So moving forward, just give me a minute. Now actually these are the documentation of valuation. Information gathered and analyzed to obtain an understanding of matter that may affect the value of the subject interest. So we need to retain sufficient documents for that, because ultimately a valuation is estimate, and estimate is based on a certain documents or information. So very important, and as per code of conduct, which is incorporated under Annexure 1 of a company's registered valuer and valuation. So a minimum retention period, that is of 3 years, and in case of ongoing cases, litigation cases, if any, relating to a particular valuation estimation, so a retention period will be till the disposal of that particular litigation. So very important to not only gather the document, but retain it for a longer duration. So what type of document needed? So information gathered and analyzed to obtain an understanding of matter that may affect a value of subject interest, or assumptions and a limiting condition, restriction or a limitation on a scope of valuation analyst work, or a data available for analysis, basis for using any valuation assumption during the valuation engagement, valuation approaches and a method considered. Valuation approaches and method used to include a rationale and a support for their use, applicable information regarding means information relating to subsequent event considered by the valuation analyst, any rule of thumb, so that under market approach, as we are aware, other consideration that include a valuation based on a rule of thumb, very important. So for any rule of thumb used in evaluation, sources of data used and how the rule of thumb was applied or considered possible in a relation to other data, and other documentation are considered relevant to engagement by the evaluation analyst or registered evaluator. So these are the document, just a list of that. And in India, we are aware we have this law provision to deal with the distress asset or a distress company. So we have a SURFACE Act of 2002. The SURFACE Act, as its name suggests, that is for mainly for three purposes: an asset reconstruction company or ARC. These are registered with Reserve Bank of India or RBI under the provisions of SURFACE Act. And as we are aware, under a SURFACE Act, the registered valuer have not got the recognition so far because under the SURFACE Act, the valuations are assigned to a valuer who is recognized under the Wealth Tax Act, not under the Companies Act. So very important. So as I can see, Prasant sir, any question, sir?
Yes, sir. Sir, in
Yes, sir.
SURFACE Act, I had read basically that in 2002 it was enacted.
Yeah,
In 2007, there was an amendment
yeah.
that not a approved valuer but a registered valuer has to do the valuation. And by default it was 34 AB at that time.
Okay.
So it was basically the concept was registered valuer, not the approved valuer. But because that time IBC was not there, so IBBI registered valuers were not there.
Yes. So
So
registered
34
valuer
AB
concept
became
in India. Yes, a registered valuer concept in India under Companies Act that came into existence only effective from October 2017 onwards, sir.
right. But in 2007, there was an amendment that only registered valuers should do the valuation for SURFACE Act property.
Yes. So meaning of registered valuer they have clarified
Yes,
that is as per Wealth Tax Act, sir.
yes. That is the
And
problem. We are fighting. I've been writing to government of that you please include IBBI also. But
yes.
some lack of this.
Yeah. So as we are aware, sir, the concept of registered valuer, registered under Companies Act, that is not universally accepted. And
Yes.
we all are aware Valuation Bill 2020 that is pending before the Parliament even after 3 years of its introduction. So once that bill is passed, we hope for that. Let us hope for that. And then a new regulatory authority is created like IBBI for the insolvency professional. At present, as we are aware, IBBI is recognized as authority under a company's rules, but that is as a stopgap arrangement, not full-fledged. So means concentration of IBBI is more on insolvency matter.
Yes.
And so that we all are aware about this ground reality. So let us hope for the best.
Yes.
So surface, yes, sir.
Many of our bank amendments are rejected only because we are just IBBI registered valuers.
Yes.
The properties go service here. So that is a problem we are facing.
Very true. So that is how I highlighted the concept of registered valuer under Companies Act. Means registered valuer, I am referring a registered valuer registered under the Companies Act provision. So that is not there under the SURFACE Act. So that we all are aware. And IBC 2016. So that is we have discussed, and Companies Act also, as we are aware, for winding up or a liquidation, there are three processes. Two are under IBC, that is liquidation and voluntary liquidation. Apart from that, there is a winding up process by a tribunal, which is under the Companies Act. And so a Companies Act also, there is a process to deal with distressed asset by way of compromise and arrangement. So separate provisions are there. Then we have a SEBI provision, and then a prudential framework for a resolution of stress asset. So that is actually mainly declared by the RBI, Reserve Bank of India. So a very important prudential framework. And last, actually, I think it is declared in 2019. So a very important. And these are the laws under which valuation is required. We all are aware, Companies Act, IBC, Ind AS, Income Tax Act, FEMA, and SEBI regulation. So registered valuer, all provision under Companies Act and Insolvency and Bankruptcy Act. So we are aware the registered valuer are authorized to do the valuation. FEMA or this Ind AS, because Ind AS actually is a part of Companies Act. So according to my understanding, we can insist for a valuation by a registered valuer under Ind AS also, because Ind AS are mandatory by way of a provision under the Companies Act. So we can take it as a part of Companies Act. And then Income Tax Act, a certain provision, a FEMA, a certain provision, and a SEBI regulation, a certain provision. The registered valuer are authorized to do the valuation. Now, actually, what we will do, since time is less, we will discuss about particular provision under IPPI regulation, and if time permits, we will come to this. Otherwise, yeah, what I will do, I will send this PPT. So what we need to discuss is this about IBBI, a CIRP regulation, or insolvency resolution a process for a corporate persons regulation 2006. So under IBBI, CIRP regulation, or insolvency resolution process for a corporate persons regulation 2016, the meaning of a fair value and a liquidation value that is provided, or the definition of a fair value and a liquidation value that is provided. That is under a regulation 2 of a CIRP regulation. So going by that, the meaning of a fair value, that means estimated realizable value of the assets of the corporate debtor if they were to be exchanged on the insolvency commencement date between a willing buyer and a willing seller in arm's length transaction after a proper marketing, and where the parties had acted knowledgeably, prudently, and without a compulsion. So as we all are aware, fair value, that is one of the standards of value or a basis of value which are recognized under IVS 104. So international valuation standard, as we all are aware, that is divided into two parts: general standard, which are applicable to all types of valuation engagement, whether plant and machinery, land and building, or SFA, or any other types of valuation engagement. So general standard, we have 5 general standard, IVS 1012, IVS 105, and we have 8 asset specific standard. So including inventory, which is newly incorporated effective from January 2022. Total in all there are 13 standard. General standard IVS 101 to 105, asset standard starting with IVS 200 and ending at IVS 500. So between these we have 8 asset standard. So very important. So fair value, that is a standard of value or a basis of value, and guidance on that we can get from IVS 104. Now actually the first standard of value which is defined under IVS 104 is the market value. And if we go through the meaning of market value, which is provided in IVS 104, so that is more or less in these lines. So that we can replace this fair value as market value. So market value means the estimated realizable value of the assets of the corporate debtor if they were to be exchanged on insolvency commencement date. So naturally in IVS 104 for market value, this insolvency commencement date is not given, it is on a measurement date. So that is the change in this particular definition. So that is ICD, between a willing buyer, willing seller, arm's length transaction. Arm's length transaction means a transaction between one related party, not between related parties. So arm's length transaction after proper marketing, where the parties had acted knowledgeably, prudently, and without compulsion. So this is actually the confusion number one, according to me, in a CIRP regulation. So what is because fair value that is defined under IFRS 13 or Ind AS 113. So Ind AS 113 and IFRS that are for a financial reporting purpose, not for a valuation purpose. So that standard of value that we need to take market value, not the fair value. So a question will come, what is the difference between a fair value and market value? So the definition of fair value as per IFRS 13, so that is a fair value, that is a price that would be receivable to sell an asset or a paid to transfer a liability in an orderly transaction between a market participant at the measurement date. So you will appreciate that this a meaning of fair value as per IFRS 13 that is different from the meaning of fair value under a CIRP regulation. Another thing, this IFRS is meant for a financial reporting purpose, not for a valuation purpose. So that is suggestion number one I had given to IBBI, that a standard of value needs more clarity. The meaning or a definition of standard of value under a CIRP that needs more clarity, that is market value and not a fair value. So that is one. Then we have a meaning of liquidation value. So that is estimated realizable value of the assets of the corporate debtor if corporate debtor are were to be liquidated on the insolvency commencement date. So you will notice that in both the cases, a valuer need to estimate the realizable value. Under a fair value also it is a realizable value, estimated a realizable value. And under a liquidation also it is estimated a realizable value. So a question will come when we have to determine the realizable value. So what is the difference? So in that actually I would like to highlight this meaning of liquidation value. So the amount that would be realized when an asset or a group of assets are sold on a piecemeal basis. So that is very important in liquidation. It is assumption is asset or a group of asset that will be sold on a piecemeal basis, that will be disposed of on a piecemeal basis, not as a whole as a whole, means company as a whole, corporate debtor as a whole. So that is the main difference. And a liquidation value need to take into account a cost of getting the asset into sellable condition, and as well as those of the disposal activity. So a question will come, what is the realizable value? So realizable value is nothing but the value which can be realized on a sale of asset after making that after bringing or getting those asset into sellable condition, and after a consideration of the cost involved in a disposable activity. So that is what is a realizable value. And there's a liquidation value. So as we are aware, IBS 104 that is giving guidance on basis of value and a premise of value. So there are a certain premise of value like highest and best use, existing use, and means forced liquidation, orderly liquidation. So this liquidation value that is determined under two different premises of value: orderly transaction with a typical marketing period, and a forced transaction with a certain marketing period. So whenever we are ascertaining a liquidation value, under the IBBI regulation, it is very important to mention exactly which premise we have relied upon, because there are two premises of premises under a liquidation value. Number one, orderly transaction with a typical marketing period. Number two, a forced transaction with certain marketing period. Very important to incorporate the exact premise of value that is used for estimation of a value. So that is about a fair value and a liquidation value, and these are a meaning as per IBS, International Valuation Standard, and IBS has referred IBS has derived a meaning of a fair value from IFRS. So IFRS 13 or Ind AS 13, we will get a same meaning of a fair value. So in other words, under IBS or International Valuation Standard, they have not given a different meaning of the standard of value, fair value, but they have derived meaning from IFRS 13. So that is a very important. And these are as per ICAI valuation standard. So we can go through that. Meaning of fair value, that is more or less same as IFRS 13 or Ind AS 113, and a liquidation value, and what is forced transaction, and what is orderly liquidation. Or these two are a premise of value, as we have seen: orderly transaction with a typical marketing period, and a forced transaction with a certain marketing period. So what exactly is the meaning? That is further elaborated in this forced transaction and orderly transaction under ICAI evaluation standard. So now we will go to this regulation 27. So means sub-regulation 1 of regulation 27 of this IBBI insolvency resolution process for a corporate person regulation 2016, that is relevant. So going by that, RP or a resolution professional shall within 7 days of his appointment, but not later than 47 days from the insolvency commencement date, appoint two registered valuer to determine the fair value and liquidation value of the corporate debtor in accordance with regulation 35. So appointment is under a regulation 27, but guidance on valuation that is provided under regulation 35. So we will go to a regulation 35. All these are actually procedural in aspect. So this is a regulation 35. So a fair value and liquidation value shall be determined in following manner. Two registered valuer appointed. Any questions, sir? So two registered valuer appointed under regulation 27 shall submit to RP an estimate of fair value and of the liquidation value computed in accordance with internationally accepted valuation standard. So necessarily we have to go by IVS, International Valuation Standard, because we need to use internationally accepted valuation standard going by this meaning after a physical verification of inventory and fixed assets of the corporate debtor. So very important to do the physical verification of inventory and fixed asset, because there are a disciplinary order issued by the disciplinary committee for not undertaking the physical verification. So a very important, and if two estimate of value in asset class are significantly different, or on receipt of a proposal to appoint a third registered valuer from a committee of creditor, a resolution professional may appoint a third registered valuer for an asset class for submitting an estimate of the value computed in a manner or provided in clause A. And a meaning of this asset class, that is clarified here. So asset class means definition provided under company's registered valuer and valuation rule. And if we go through this definition, so that is plant and machinery, land and building, and SFA, we are all getting a registration. Now, actually, my suggestion number 2 to IBBI is on this. Because see, here by a regulation, RP is compelled to appoint asset class wise registered valuer. So again, I will repeat what is the purpose of insolvency resolution. That is, purpose is to ownership transfer. So when actually it is ownership transfer, what is handed over to the prospective resolution applicant or a prospective buyer is a company as a whole, as a going concern, not a different asset class. So when you are making a valuation of a different asset class, so naturally there will be many inconsistency in this because six valuer will do a valuation. That they may have their own judgment about the valuation. That is one drawback. Drawback number two, if you are not considering the liability at all when you are doing a valuation as per income approach of a company as a whole by FCFF, free cash flow to farm or a free cash flow to equity, then you are considering the liability portion also. You are considering the financial position of the company as a whole. But when you are breaking down the evaluation of corporate data into three parts, then you cannot attach assumption of a going concern with it. So once you are not attaching the assumption of a going concern, probably the valuation estimation, which is asset class, may not give a correct picture, may not give a true value of the company, may not result in a maximization of the value of the corporate data. So that is the drawback. There is a need to make a valuation or there is a need to determine market value of the corporate data as a whole instead of asset class wise. And this asset class wise evaluation, that is correct valuation for determining the liquidation value, because we have seen what is the presumption in liquidation value, that asset will be distributed in a piecemeal basis. So once it is distributed in a piecemeal basis, then actually it is all right to make asset class wise evaluation, but certainly that is inconsistent when we are making a valuation with the valuation standard of market value or the fair value as per this CIRP regulation. So that is a suggestion I have given, and this will clarify because in many sessions like this, I come across a question. Supposing I have derived a fair value of 100 rupees, so what I need to make estimate of the liquidation value, because both are asset class wise. So both are, if asset class wise, there will be a virtually very less difference or a no difference or a no different method of valuation of market value and liquidation value. But when you are doing estimation of market value of a corporate debtor as a whole, and you are doing a valuation, liquidation value estimation asset class wise, so naturally you will get a different valuation estimation. So that is what I have suggested, and in that regard I would highlight this actually this this I have again, what is the asset and what is the asset class that I have given, and a going concern assumption versus a valuation of each asset class. So I have actually highlighted this. Time is short, so we will skip this. But I will actually highlight this. So under regulation 32 of liquidation process regulation. So here it provides that a liquidator may sell an asset of on a standalone basis or asset in a slump sale, a set of asset collectively, a asset in a parcel, a corporate debtor as a going concern, or the business of the corporate debtor as a going concern. So under a liquidation process regulation, there are a variety of scenario, situation, assumption under which evaluation need to be done. We have a scenario A to F, or we have a 6 scenario under which evaluation needs to be done. Asset on a standalone basis, asset in a slum cell, asset collectively, asset in parcel, corporate debtor as a going concern, or a business of the corporate debtor as a going concern. So that is and here actually the relevant is here this regulation 35. So as we can see, regulation 35 where means in case not covered under sub-regulation 1, our where liquidator is of the opinion that fresh valuation is required under the circumstances. So he shall within 7 days of the liquidation commencement date appoint a 2 registered valuer to determine the realizable value of the asset or a business under clause A to F of regulation 32 of the corporate debtor. So regulation 32 of the means liquidation process regulation, these are these 6 situation or a scenario under which valuation needs to be done. So my point is a liquidation process that is the last resort. So valuation scope is much wider than a valuation scope in CIRP. So be careful when you are quoting your professional fees for valuation under a liquidation process regulation because scope is much wider. You need to arrive at a valuation estimation under 6 these different scenarios. So very important. And moving forward, one more thing I would like to highlight before we close. So this sub-regulation 3, a registered valuer appointed under a sub-regulation shall independently submit to the liquidator estimate of realizable value. So a realizable value again is a standard of value or a basis of value. And if you go through the guidance provided under International Evaluation Standard, more particularly IVS 104, you will not get what exactly is meant by a realizable value, because that is not one of the standard or a basis of value. And in a CIRP regulation, we have seen the definition of fair value and a liquidation value is provided under a CIRP regulation itself. But under a liquidation process regulation, what is meant by this realizable value, that meaning of that or definition of that is not provided. So I have again suggested to the IBBI to make clear what exactly is the meaning of realizable value, because that is not a standard of value or the basis of value as per IBS 104. This realizable value is definitely used in valuation. That is nothing but the amount realized after putting the asset into operational condition or sellable condition, and less whatever cost involved in a disposal. So that is what is realizable value. That we understand traditionally, but meaning of that should be specified in a liquidation process regulation as has been done in a CIRP regulation. And again, this is the inconsistency. All regulation, whether it is CIRP regulation, whether it is IBBI fast track regulation, whether it is IBBI PPIRP regulation, whether it is IBBI IBBI regulation for a personal bankruptcy cases. So everywhere valuation need to be done going by internationally accepted valuation standard. But only in case of a liquidation process regulation, valuation need to be done by a company's registered valuer and valuation rule 2017. So that is inconsistent because that should be made uniform. All regulation that should be internationally accepted valuation standard only. With that, actually, we are arriving at the end of this session. It is over for me. This marathon 2 hours non-stop. And I thank each one of you for your attention throughout the session and making it interactive. Because of paucity of time, we will end here. this subject, as I told you in the beginning, even if we discuss for a whole day, probably we may not give a full justice to this session. And today being a Sunday, I don't want actually to prolong this session. So I will end here. And before we finally end, any questions from your side on whatever we covered today?
Yes, sir.
Yeah, please go ahead, sir.
Sir, that you mentioned about that threshold. How much is that threshold now? Like,
For a commencement of CIRP proceedings, sir,
yeah.
it is 1 crore, sir.
And earlier it was less.
It was 1 lakh only, sir. When actually this IBC was introduced, effective from 1st of December 2016.
Okay.
So that was 1 lakh only. And immediately after outbreak of COVID, so somewhere on 23rd or 24th of March 2020, government issued a notification under IBC.
Okay.
And by virtue of that, now it is 1 crore rupees, sir.
And sir, you mentioned about operational creditors.
Yeah, sir.
So why I'm asking now, because living in Noida. So we have been interacting with JP, Jayaprakash Infrastructure Limited. So they've gone under liquidation. So I was talking to them, their IRP also. So he was saying that if it is like income tax department, they have gone to NCALT. So they were saying that if it is operational creditor, then it will not have much of value in stopping, or legal value is not there of operational creditor. If it is
so, sir, I understood your question. Your question is about JP Infratech, and that relevant regulation is a liquidation regulation.
correct.
So if you go through the liquidation process under IBC, there is no differentiation between operational creditor and a financial creditor.
Correct.
So that differentiation is there only under a CIRP, not under liquidation. Liquidation, we have to go by waterfall mechanism, which is provided under a section 53 of IBC, sir. So there will be no differentiation of operational creditor or a financial creditor under a liquidation process regulation, sir.
I see. So
Yes,
why are they claiming that no, it is not having much of effect? That's why I'm asking. So they're
so generally, sir, in a waterfall mechanism, priorities of distribution of realization, because what is liquidation? All the assets of the corporate debtor will be disposed of, and whatever are the realization that will be distributed according to the priorities which are given to a different stakeholder under section 53 of IBC. So actually, a general experience is by the time a corporate debtor goes into liquidation, a value of asset is so deteriorated, realization is very less, and that many times is sufficient for liquidation fees or liquidation expenses. So means the other creditor and a secure creditor. Of course, secure creditor, there will get their share. So other creditor, they get very less, and particularly this income tax department or government, they are actually at lower level of priority. So many times they don't get anything, sir. You refer to section 53, you will come to know about priority, sir.
section 53 of CIRP.
No, IBC, sir.
IBC.
Insolvency and Bankruptcy Code, and that will provide you the waterfall mechanism or priorities of distribution.
Waterfall mechanism, that is called.
Yeah, we popularly know it as waterfall mechanism.
Okay. And sir, you mentioned about that state of CD. What is CD? State of CD, you were mentioning something.
Corporate data.
As a corporate debtor, you were saying CD.
Yeah.
Okay. And 76% BIFR.
That is, sir, actually means when IBC was introduced. Prior to that, actually, we had SICA Act, and under SICA Act, BIFR was constituted, Board for Insolvency and Financial Restructuring. Okay. So actually, all those cases were transferred to IBC once IBC was introduced, because SICA was repealed when this earlier law was repealed. It became unoperational. So whatever pending cases, these cases were transferred to IBC, sir.
So BFIR is okay. What is SICCA? You are saying SICCA?
SICCA means a Sikh Industrial Company Restructuring Act.
Acha, okay. SICCA, okay. And sir, one
That
more-
is now repealed. That is no longer in existence after 2016.
Okay. Sir, once I had gone to Indian Habitat Center and the chairman of IBBI was also there. So there was a discussion, I was new that time as earlier. So they were trying to say that why there was a major discussion on that when any company is going for liquidation, then why we go for fair value? Because it is already known of the value of the company, then why are we wasting time? And it was an open discussion was happening in auditorium there.
So if you, sir, go through the guidance provided under liquidation process regulation, the guidance is the whatever valuation estimation is there, which was done during CIRP. So if those estimate is valid, then no need of fresh valuation under liquidation. But many times CIRP process takes 1 year, 2 year. By that time, actually, earlier valuation estimation may become outdated, and a liquidator may feel a need for a fresh valuation, or the stakeholder committee under liquidation process. We have a concept of constitution of stakeholder committee. So if they feel the need, then only there is a need to appoint a fresh valuer under a liquidation process regulation.
Okay.
Otherwise, there is no need, sir. That
Correct.
guidance is there in liquidation process regulation. And in part of my PPT also. Once you get that PPT, please refer to that, sir.
Okay. And sir, then what you
It seems I am just lighter side. It seems you have prepared entire question paper for me, sir.
No, it's not. These are
Good.
these are very practical and genuine questions I'm trying to ask, like practically to be implemented on ground. That's why.
Yeah. Please,
whatever
sir,
I said. Yeah.
Go ahead, sir.
Okay, and then you generally talked about like SFA, and say
Yes.
land building if you have to convert, because I had been seeing that realized value is taken as 0.9%, or distress value is taken as 0.85%. So any comment on that? Because like company, you are conveyed about company distress happening now, whatever you had conveyed, and it offshoot of that company distress is going to be on assets class, like P&M, plant and machinery, as well as for land and building. I am land and building. So how to transfer it from company distress value, like you have conveyed? Basically, you have conveyed that overall scenario, company going under distress. So now it is to be transferred. So either we make use of some rule of thumb, like you were mentioning.
So, sir, land and building, actually, I don't think if company is in distress, the value of land will deteriorate, sir, because of distress. See, land ultimately, if that land is located in a prominent area, in a post area, so that will give a value according to market condition. So no actually effect of a distress of company on a value of land, because that will be market driven. Value of distress will certainly come on a machinery, because if machinery is not used for a longer duration, so probably because of that machinery may not be operationally capable. Sir? So we may actually need to make a certain discount in a value of plant and machinery. But supposing if I am having a plot of land in say Noida, a good industrial area. So how actually there will be effect of distress of a company on value of land? That will be market driven, sir. So that is my understanding. Again, that will depend upon a case to case basis. As you are aware, valuation is not a generalized thing. So that will depend upon the ground reality or information or document or details which are available at a particular point of time. But means according to me, the land value not have a major impact. A building actually, again, depending upon the what type of construction is that, what is the demand of that building in a market. So based on that, a value of building may deteriorate, but not certainly the value of land if it is located at a post area or a prominent place. So that is my understanding.
Only my submission, sir, is here that you said that land will also have some effect, because logically, when we say that it is under like a legal case or under some dispute or
Then it is
liquidation.
altogether different thing, sir. I am actually talking about land which is having clear title, sir. If some actually,
Once we are talking about liquid, it is undergoing liquidation. So like even if suppose my land is under debt or something happening, even banks, they say that if under liquidation, then like in comparison of market, one gets on a lower rate.
sir,
Yes.
a bank actually, if the corporate debtor has created charge of land, and certainly that needs to be considered, and that will be that will fetch less value, sir. So
Yes.
I am talking about the title of land which is a clear title. So many
Oh.
cases we may come across where title
Understood.
is clear of land
Understood.
and building.
Okay, okay.
Sir.
Understood.
So if a title is not
Understood.
clear, then
The title is-
certainly that is not because of a distress of company and nothing to do. Or if company is solvent, then also they can take the finance from bank by mortgaging the land and building. Sir. So so that will remain in insolvent condition also. So what I talked was title is clear.
Okay.
Sir, one small doubt, sir. Sir, regarding the
yes,
SFA valuation, the valuation of stock to be done by the valuer, sir, there is a great question mark in now the practical situation.
Yes, sir. Very true, sir.
Yes,
So
sir.
your question is very valid because nobody is owner of inventory. That is
Yes,
the
yes.
ground reality, because land and building valuer will say no, no inventory valuation we will not do. Plant and machinery they will say we will not do. So residual is SFA. Now
Yes.
actually that that clarification needs to come up by way of a statutory provision, by way of regulatory provision. Because what we have seen in the recent past, disciplinary committee has
Yes.
issued order, and there they have made clear inventory valuation is SFA job. But where is the provision, legal provision for that? That is number one. And number two, the valuation of inventory that is technical in nature. And SFA valuer may not be equipped to do the valuation of inventory, because there are different types of inventory, like bulk cargo inventory, liquid cargo inventory, package inventory, then we have a petroleum product inventory, chemical inventory, machinery inventory. So SFA valuer is not capable of doing that. And ultimately what he will do, he will take assistance from a certain expert. But expert valuation report he may attach with the valuation report, but overall responsibility according to regulation is of SFA regular. So overnight I cannot become, I am also SFA valuer. So overnight I cannot become so expert that I will review the valuation report of an expert. Supposing it is a valuation of gold ornament, supposing, and a jewelry company, or supposing it is of this artwork. So I am not actually expert in artwork evaluation, but I have to take full responsibility. So whether that is proper or not, that needs to be taken up through RVO. All RVO need to take a joint actually a representation, and this needs to be resolved actually because I am also with you, sir, as a SFA valuer. There's
Yes.
I have worked 35 years in a petroleum company, and I know how difficult it is to value inventory of a petroleum company. So it is not an easy task, sir. So that needs to be taken up, sir.
Yes, one colleague he received the notice from the IBPI for the explanation also. That's why I'm asking this question.
Yeah. In the recent past, sir,
Yes.
disciplinary orders have
But
also
sir,
been
Yes.
issued.
Yes, sir. Yes, sir. Thank you, sir. Thank you for kind information. Thank you.
Thank you.
but sir, nowadays this matter is very much clear among the all IPs and IRPs. They are very much understood about the inventory valuation question. So it is IRP or IP's job to see the nature of inventory, what kind of nature of inventories are there. If the inventories are of mechanical kind, those should go to plant and machinery valuers. If inventories are of civil kind, like tiles are there, some concrete are there, some civil construction material are there, then you should go to land and building valuer. So it is IRP or IP's job what nature of inventories are there, and that should be clearly mentioned in appointment letter also. So nowadays, this practical scenario is there among the all IPs and IRPs, and they are very much understood the situation.
I fully agree, sir, with you. But there are certain areas. Supposing I have come across a case, sir, that was relating to valuation of a hotel, means a very big property, and in that certain artwork was there, sir. So artwork was also part of asset. Now it will not fall in the domain of plant and machinery. It will not fall in domain of land and building. So residual is SFA. Now SFA, what he will do, he will take some help of some expert, and ultimately he has to endorse. So overnight, how I can become expert of valuation of artwork or a valuation of supposing a jewelry company, ornament, gold ornament, silver ornament, or even a valuation of diamonds and all precious metal, or a valuation. There are many classes, sir. A valuation of a petroleum company. So inventory of a petroleum company, inventory of a chemical company. That is, sir, a very technical in nature. Measurement of inventory itself is a technical, and valuation actually again what is there in books. So as per financial reporting standard, inventory is reported in books in a financial statement either at cost price or a realizable value. So realizable value and cost price, that is entity specific. Whereas you need to determine market value of inventory at the marketplace. So there is a wide difference in these two standard of value. So all these are factors, sir, and this needs to be taken up actually emphatically with the concerned authority. That is my understanding, sir.
So one last question, sir. Mine.
Please, sir, go ahead, sir.
Sir, supposing there is a trust which has been assigned, there is a land assigned to a trust, and that trust has built a school. Now that school is doing good business, but and now how do we evaluate? Do we evaluate it on cost basis, cost approach, or income approach?
No, sir, valuation is of land and building or about.
Yes, land and building part. I am a
So,
land and building valuer.
So you are doing a valuation on behalf of whom, sir? Whether a behalf of a school or whether on behalf of the landowner?
No,
Purpose of
the
valuation will be vital, and who is the client, that will be vital, sir.
yes.
Purpose and
Now
a
this is,
client.
yeah, supposing this is a school. This is for CRP. Supposing that
School is in CIRP.
yes, maybe. Now what we
No,
do?
but that is a company. You told it is a trust.
Yes.
So trust are not covered under CIRP
Yes,
or
yes,
IBC process.
but not in CRP, right? But
So
if
there will
supposing there is a case,
purpose will be actually of vital importance, sir.
okay.
So
If it is
under
for
which
school,
regulation, first you need to clarify under which regulation you are doing the valuation. What is the
okay.
purpose? What is the need?
Hmm.
So all this
Okay.
will matter, sir.
Okay.
First, we have to get clarity on exact law provision under which valuation is required, sir. Society and trust are not covered under IBC, sir.
Yes, right.
Yeah.
Okay.
Okay, sir. So
Sir,
we may
sir.
interact anytime. Yeah, please
Sir,
go ahead, sir.
last thing I would like to tell you, you mentioned about the artwork or jewelry or gold kind of ornaments. Those are the inventories. If we say those are the inventories, okay. So yes, none of the asset class valuer is expert in those inventories, SFA, PM, or land and building. But yes, being an engineer, plant and machinery or land and building valuer, definitely an expert as far as material of construction, manufacturing processes are concerned. They can make better inquiry, better market inquiry as compared to SFA valuers. So by this way also, they should assign inventory valuation to maybe PM or maybe land and building value.
Very true, sir. I fully agree. I fully endorse your views. Wherever whatever I talk was where actually we cannot decide a specific asset class. Supposing it is a valuation of a real estate company. So land and building valuer are more equipped in that, sir. So that should fall within the domain of land and building. Like that engineering company, equipment manufacturing company. So that should fall within the ambit of plant and machinery. And clarification about this allocation of valuation of inventory, that also needs to be within the framework of regulation. I fully agree with you, sir.
The chartered engineer, the opinion can also be obtained in this case.
Charter engineer, that I clarified, sir. We can very well obtain the opinion, but ultimately you are the final responsibility. That is the whole time. Whatever charter engineer has said, sir,
Yes.
I cannot become overnight expert to endorse whatever he has told, actually. That final responsibility is with me, not with the charter engineer. That I want to highlight, sir. So if I am endorsing a work of some other expert, I need to more expert than him. Then only I will be in a position to endorse his work. Otherwise, how I can endorse it? That is the whole thing, sir. So once again, thank you very much. And we have a very lively and interactive session. Probably we will have more such session in a future if given the opportunity. So with that, actually on this Sunday, we have already exceeded our time. So thank you very much. And we will end our session, and I will hand it over back to the organizers.
Thank you. Thank you, sir. Thank you.
Thank you, sir. Thank you.
Thank you, sir.
So, thank you, sir. So we have come to the end of this CEP. I thank you, Chatwani, sir, for taking this assignment and covering the topic very nicely and in very clear manner. The topic is very important, and I hope that participants would have surely benefited from it. I thank all the participants for joining this CEP. We have some participants from Association of Valuation Professional today. They have joined for the first time. I thank them very much for joining. Please share your feedback, and also I'll be grateful if you could suggest topics for our future CEPs. Thank you very much. Thank you very much, Kajal. Thank you very much, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.